Welcome to week 9, and this week we're going to be concentrating on the Elliott wave, how to count the Elliott wave, how to understand what the market's telling us, how to use the 534 oscillator, and also we're going to practice counting how to determine the end of a trend, and we'll go all the way up to big 5 waves in the Elliott wave, all the way down to a single bar analysis. So let's get on with it. Day 1, week 9, the Profittunity tools. Our goal this week is to define and understand the 5 magic bullets in the Elliott wave. The 5 magic bullets will basically kill any trend, and the most important information you could possibly have to trade is where is the end of a trend. So let's break that down now, and let's go to our job for today. Our goal today is to understand how and why the 5 magic bullets in the Elliott wave are used in the overall technique. We want to look at single bar analysis, and by the end of the day we want to understand and we want to define exactly what we mean by divergence. The 5 magic bullets are these, and these will kill most any trend. The first magic bullet, and there's no particular order, they all have to be there, is price in the target zone. The second one is a divergence between the price and the oscillator. The third is a fractal. All trends will end in a fractal, and all fractals will have a squat in one of the top or bottom 3 bars. And then we want to change in momentum. Let's break that down, and let's first of all look at divergence. Here we have a chart where the price is going up, and then it comes back and goes up, comes back and goes up again. This is the price chart. We look at the divergence between the momentum and the price, and here is the 534 oscillator. We call it the AO, and AO, as you know, stands for the awesome oscillator. And we really believe that we count the Elliott wave as good, if not better, than anybody in the world. Now that may seem immodest, but we have a secret. And that secret is we count the Elliott wave on the momentum chart rather than the price chart. Divergence, what divergence is when the price goes higher. For example, in this particular chart, the price starts, it comes up here, it comes back, and then it goes up higher, but the momentum does not go up higher. So at this point we have a high price at that particular instance in time, and we have a high momentum. Over here on the right we have an even higher price, but notice that the momentum is not as high as it was there. And that's the definition of divergence. The price is going up, but the momentum is not going up. So here is the divergence between those 2 angles. Let's take another look. Let's take a look at double divergence. We have a price chart here that's going up and down and up and down, and then we have the oscillator, the 534 awesome oscillator. We have a price at this point, and then we have a higher price. We have momentum at a high at this point, and at the second point it's less high. That's a divergence. Now if the price continues on up in this region higher and the divergence still comes down, which means that the momentum at this point is less than it was at the middle point and less than it was at the beginning point, that we call a double divergent. Now it takes a price, a higher price, and a second higher price with a high momentum, a lower momentum, and a second lower momentum to create a double divergence. Let's look at that in the market. And by the way, almost all trends will end in a double divergence. Every now and then you'll see a triple divergence, and very rarely will you see a quadruple divergence. So let's look at an actual price chart here. This is the movement, the direction of the movement of the highs. We have a point 1 here, which is a high, and at point 2 we have a higher high. And now let's look down at the 534 awesome oscillator. At point 1 we have a high, but at point 2 we have a lower high, and that's what we refer to as divergence. So the difference between those 2 angles is divergence. Now let's break this down very, very small, and let's look at 1 bar. So if we have divergence in the market, and then we have what we call a divergent bar. This is only 1 bar. A bearish divergent bar would have a higher high and a higher low than the previous bar, but it closes in the lower half. Let's take a look at that. Here you can see on these green bars, we're in the green zone. We have a bar, we have a higher high on this middle bar here, but it does not close in the lower half. And here we have a higher low, we also have a higher high, and it closes in the bottom half. Now, what that signifies in market behavior is that the beginning of this period, no matter what time frame it is, whether it's 1 minute or 1 hour or 1 month, the buyers were in control and they were able to take the price up to here. But we know that at the end of this bar, again, no matter what time period we're talking about, that the sellers were in control. Now, if you really want to get aggressive in trading, what you might do is sell this, even though it might be outside the alligator's mouth. Now, what we've been talking about for 8 weeks now is using the alligator as our odds maker and as our decision maker. If the price goes away from the alligator quite far, the alligator will act like a rubber band. It will try to pull it back. So the first job we have is to learn exactly what the rules are, and then as we gain experience and develop the art of trading, we know something even more important, and that is we know when to break the rules. Let's look at this on a bar chart. Here we have a bar chart, and the market is coming up. The new information pushes it away from the alligator. It comes back toward the alligator, then some more new information comes up, and look what we have here. We have a bearish divergent bar. Not only is it a bearish divergent bar, it's also a squat bar, as signified by the blue color, and it's a 3-3 extreme. Remember from the novice level and from our first book, Trading Chaos, this is an important squat. So if you were very, very aggressive in this area, you might choose to sell the bottom of this, even though you're going back in and you might normally be feeding the alligator. There are a couple of advantages to doing this. If you do this, you have the world's best trade location. You also have a very short loss potential, because if you went short here on the red bar, your stop would be just above the blue bar. So you would have a minimum risk here. Reviewing, a bearish divergent bar has a higher high and a higher low, but closes in the lower half. This is an example, and this is a perfect example here. That's a bearish divergent bar. Let's look at a bullish divergent bar, which is basically the same thing, only on the other side of the chart. It's on the bottom of the chart. A bullish divergent bar has a lower low, and it also has a lower high than the immediate previous bar, but it closes in the upper half. Here we're in the red zone again, and we have a red bar, a 1-3 bar, followed by a 1-3 bar, and then this bar has a lower high, the third bar, and it also has a lower low, but it closes in the top half, and that creates a bullish divergent bar. Let's look at that on the chart itself. And on the chart itself, we have here the market is coming down, and notice that this is not a bullish divergent bar. That's not. That has a lower high and a lower low, but it closes in the lower half, so that doesn't count. This one doesn't count because it doesn't close in the upper half. But look at this one. It started here. The sellers brought the price down to here. The buyers brought it back up to here. It has a lower high. It also has a lower low. So therefore, it is a bullish divergent bar. Now, let's practice this a little bit, reviewing just for a moment. A bullish divergent bar makes a lower low, lower high, closes in the upper half. A bearish divergent bar makes a higher high and a higher low, but closes in the lower half. Let's look at this on a chart. Let's see if we can find some divergent bars in this particular chart. Here's a couple of hints. There are 4 divergent bars on this chart. If you're having a hard time seeing these, all 4 are on the left side of the chart. 3 of them are blue bars, and 1 is a red bar. So let's start over here and see if we can find any. Here's a lower high and a lower low on this bar, but it doesn't close in the top half. That's followed by another bar with a lower high and a lower low, and it closes in the top half. Not only does it do that, it's also a squat bar. So this would be a bullish divergent bar. Here are all 4 of them. And if we come over here to the middle part, none of these, this is not a bearish divergent bar because it doesn't close in the bottom half. This is not because this is a bullish divergent bar here. This also is a bullish divergent bar here. It opens down here and it closes in the top. So we have 2 bullish divergent bars side by side, and then the market takes off. Then it comes back and we have another bullish divergent bar, lower high, lower low, close in the top half. And then we come up and we have a bearish divergent bar, and it is a squat bar. So that's pretty important. And you can see what the market has done after that. So what we're doing now is we've looked at the bullish and bearish divergent bar, and let's take a little bit more practice. Let's see if we can find some more. Now there are a number of them on this chart, and let's start over here at the end, and we'll go down this direction and see. We'll mark them each one. What we want to do is mark the bearish and bullish divergent bar. Here's our first one. It's also a squat bar, notice, and notice the bar just to the right of that. That's also a bullish divergent bar. Now we're coming up and we keep going. Here is another bearish divergent bar moving on up. We have a bearish divergent bar here, and if you were really trading this, you would have a stop at the bottom of that bar, but that was never hit. And we come on up here to nothing in this area, nothing in this area, and we have to come all the way over here to find a bullish divergent bar. Now, had you taken the top of this and bought it, you would have been filled over here. You would have never gotten out because your stop would have been down there. Let's see if we can find any more bullish or bearish divergent bars. As we're moving over here, this is not one. What about this squat right here? That's one. That is a bullish divergent bar. As we're coming up on these greens in this area, is there anything here? It looks like that might be a bearish divergent bar, doesn't it? So if you had your stop in at this point, your stop would have been at the bottom to sell at the bottom of this. It would have never been hit. Then look at this bar at the top. That is a bearish divergent squat. And anytime we get a bearish divergent squat that's away from the alligator, remember this is going to act sort of like a rubber band, that might be one to take for the very aggressive traders. If you're not a very aggressive or experienced trader, we suggest you don't do this. But again, this is breaking the rules, and the key is knowing exactly when to break the rules. Now we want to show you something else. We want to show you how the alligator and the Elliott wave work together. And you don't really have to know exactly how to count the Elliott wave precisely, although we're going to spend this week doing that. The alligator will take care of you. Anytime the price is outside the alligator's mouth, you're in an impulsive wave. Anytime the alligator's inside the mouth, then you're in a reactive wave of the Elliott wave. And we look at the market as if it's a racetrack. And in the racetrack, you have straightaways here, and you have curves going around. And the cars go around these at different speeds. For example, we'll divide the straightaways from the roundabouts, or the curved end of the racetrack, and we have a car here. And this car is a racing car, and the object is to get there before anybody else does. Now, let's assume that on this racetrack, you can go an average of 200 miles an hour on the straightaway. But if you go 200 miles an hour on the curve, then you're going to have an accident. You can only go about 140 miles there. So if you're going to be a conservative trader and say, I'm only going to trade at 140 miles, everybody else is going to leave you behind there. If you're going to be an aggressive trader and say, I'm going to trade at 200 miles an hour, then you're going to wreak havoc. You're going to have a wreck here. The way to look at this is anytime the gator is open, we're in a straightaway. Anytime we're in an impulsive wave, we want to trade the market and take profit from it. So in the top straightaway and the bottom straightaway, we have both an open gator, and it's also, from an Elliott standpoint, an impulse wave. On the ends of the racetrack, we have the closed gator, where the price bars are intertwining with the alligator's mouth on both sides. And again, if you trade at 200 miles an hour, here's what's going to happen to you. You're going to have a crash here. If you trade at 140 miles an hour on the straightaway, you're going to be left behind. So think about that illustration. We think it's a good one, and we think about it all the time. Where are you on the racetrack of the market? If you're in an impulse wave, if the gator's mouth is open, you want to be there and be there aggressively. If you're in a correction wave, you either want to just stay out, keep your powder dry, or trade on a much smaller time frame. And because on a much smaller time frame, you do have some impulsive waves in there. So that's about enough for right now for today. Reviewing what we've done today is we've looked at divergences, we've looked at double divergences, we've listed the 5 magic bullets, we've taken it all the way down to 1 bar, so we know what a bullish and bearish divergent bar is, And we've used this illustration of the racetrack to impress you, we hope, that you trade differently in different time frames, you trade differently in different Elliott waves, and you trade differently depending on whether you're inside or outside the gator's mouth. So have a good evening, have a good date with yourself this week, do the morning pages, and the AT will be back with you tomorrow. Today what we want to do is we want to review the fractal formation. We want to look and again review the change in momentum, exactly what that means. And then we want to go to something that's a little bit new in the Elliott wave, and that is the target zone. The target zone, remember, is one of our 5 magic bullets. And the target zone is what we have found is that it's one of the most consistent predictors of the end of a trend. The target zone is where that end of the trend will end. And when you get the other 4 bullets in there, that's almost a gimme. So let's go to day 2 of week 9 of the Elliott wave. As you well know, the fractal is a minimum of 5 consecutive bars, where the middle bar is higher or lower than the previous 2 bars and the following 2 bars. We'll look at this chart. The fractals are important this week because the fractals are one of the 5 magic bullets. And one of the things you will always know is that a trend all trends will start and end in a fractal. For example, in this particular chart, there are a number of fractals, and you will notice that the price is staying away from the alligator's mouth. It peeks back into the alligator's mouth periodically, but it basically stays outside the alligator's mouth. When we look at the divergence, we're going to also look at this chart because this is a very unusual chart. We had a number of divergences up here, and we had a fractal on the top. We had all 5 magic bullets. This is the S&P. And the interesting thing is that in the next 6 days after this top, which was very easy to predict, one contract lost over $68,000. So here we have a fractal in the beginning, and this fractal is right here. If you trade your fractals, you will never, it's guaranteed, you will never ever be left out of a trend like this. So this was our first entry on this trend, and fractals will always end a trend. And here you have a fractal up ending a trend. So the fractal, just a quick review today. We won't spend much time on this. Just to remind you that all trends will end in a fractal, all trends will begin in a fractal, and the fractal is one of our 5 magic bullets. So, and the more magic bullets you have in any trend, you're coming closer and closer to the end of that trend. So let's take a look then at what we're talking about by a change in momentum. Change in momentum is very simple. This is the 534 5 awesome oscillator. It's also a close approximation to the running MFI, the Market Facilitation Index, which we discussed very thoroughly in our first book, Trading Chaos. I'm assuming that you understand what the MFI is, and this momentum indicator, this 534 5 awesome oscillator, is one of the most precise tools we have ever found in trading. A change in direction of momentum is indicated by a change in this oscillator, and to make it easier, what we've done is we've programmed this so that if this particular bar is lower, less momentum than the previous bar, we color it red. If this particular bar is higher and greater, more momentum than the previous bar, we color it green. So all you have to do is look at the colors. And we can program these, or you can program these on basically anything. This chart we're using is a commodity quote graphics chart. It also works on Telerate, on AIQ. It works on Advanced Get. It works on Supercharts, TradeStation, Windows on Wall Street, DTN. Works on almost anything that's out there today. So the thing we want to look for here is a change in momentum. Now when we have the other magic bullets up here, we have a fractal in the top. We have a squat on one of the 3 top bars here. And when we get a change in momentum in this area, that becomes then very significant because the momentum will always change before the price does. And here you see the momentum change several days before the price change. Now, the next magic bullet we want to look at is the target zone. And as I've already mentioned, this target zone is one of the most consistent predictors to come out of the Elliott wave. It's really quite simple, and we'll show you exactly how to do it. And most software vendors have in their arsenal a Fibonacci expansion that will let you do this with just a couple of mouse clicks. First thing we want to do is find the difference between the top of wave 3 and the beginning of wave 1, or if it's in a down market, the bottom of wave 3 and the beginning of wave 1. So here we have wave 1, 2, 3, and what we want to do is take that price difference, the price at 3, and subtract the price at the beginning of 1. So when we take that price difference, and then what we want to do is go over to wave 4 and add that price difference to there. So what we've done very simply is we've taken the distance between the top of wave 3 and the beginning of wave 1, this distance here, that length, and we've transferred that length over to the bottom of wave 4 and added it to wave 4. Then the next step is very simple. All we do is we take 100% of that, which would be the top of that bar, and 62% of that. And what we found in actual practice is 92% of the time, that's 9 times out of 10, this fifth wave is going to end up here in this 62 to 100% of the distance between the beginning of wave 1 and the ending of wave 3. Let's look at that on a chart now. The target zone in the chart. Here we have a chart, and we've knocked off a little bit of the left side of the chart so you can see it better, so it'll be a little bit clearer. But we know that this is wave 3 because it peaks. We'll talk more about that a little later this week. We know that this fulfills the minimum requirements for wave 4 because the oscillator came below 0. We'll also come back to that tomorrow. But right now, we want to take the difference between the wave 3 up here, which was 189 even, and the beginning of wave 1 was 156 even, and that difference is 3,300 points. Then we come over here to the bottom of wave 4, and we add that to the bottom of wave 4, and the end of wave 4 is 181.15, so 100% of that, added that, 3,300 to 181.50 would be 214.50, and 62% of that would be 201.96. And then we'll take this 3 and 4 and 5 and put in the target zone. 100% is up there at 214.50, and 62% is there at 201.96. And sure enough, this was the end of the fifth wave. This was wave 1, 2, 3, 4, 5 of the fifth, and it ended here, and the next move was a considerably fast move down. So this target zone is one of the most important of our 5 magic bullets because it's highly predictive. It's going to be right over 9 times out of 10. So with that kind of odds, you can hardly miss. That's probably enough for us for day 2 of week 9. Get a good night's sleep, do your AT, do your morning pages. We'll come back tomorrow, and tomorrow we're going to be putting those 5 magic bullets together so that you can see how they work in the market for picking out the tops and the bottom. So have a good night. We'll see you tomorrow. Perfect. Here we are at day 3 of week 9, and our job today is to learn more about the 5 magic bullets and how we can use the 534 Awesome Oscillator in accurately counting the Elliott wave. We're going to look at a half a dozen charts or more, and we're going to put both of those together, counting the Elliott wave using the 534 oscillator and also the 5 magic bullets. So let's get on with it and have some fun today. And what we want to look at first is that bullets, the magic bullets in action. And we want to look at this chart, for example, and this is the same chart we were using yesterday. This is an S&P 500 chart that was a fantastic success with a great deal of profit going all the way up through here, and we were quite successful in predicting the exact top of it. And we used the 5 magic bullets. And let's look at how we did that. The first magic bullet is the target zone. The target zone came out to be right there, and the market ended up almost exactly to the tick in the middle of that projected target zone. And remember, that's the target zone we were talking about yesterday, where you take the price difference between the beginning of wave 1 and the end of wave 3, and then project that onto wave 4. So that's our first target zone. That's our first magic bullet, is the target zone. The next magic bullet is divergence, and notice that the price is going up continually, and the momentum is getting less and less on each price extension. In fact, here we had something that was very, very unusual. We had a quadruple divergence. Now, quadruple divergence takes 5 prices. Here's 1, 2, 3, 4, 5. And you only see a quadruple divergence once in a blue moon. A few times every year will you see that much. And that gave us a great deal of confidence that we were approaching the end up here with this divergence. So we had 2 of the magic bullets. We had the target zone, we had divergence, and we had another magic bullet, and that was we had a fractal right up here at the top. Not only did we have a fractal, but that fractal had a squat bar on that very day of the top. So we had 3 of our magic bullets in, the target zone, the divergence, the fractal, and we also had a squat. That top bar was a squat. So we have one more magic bullet that we must look at to make this picture really complete, and that is we must have a change in momentum. And that's exactly what we had here. On that top day, we had a change in momentum from up to down. So we suggested to people that they exit at the end of this bar. The next day was down, and it continued down for 6 days here. And on a one contract basis, that loss from here to here was over $68,000. So hopefully that will give you an idea of how important it is to use these bullets. And when you have all 5 bullets, that almost always, almost invariably kills any trends. Let's look at that 534 oscillator in a little bit more detailed basis here. We count the Elliott wave from the 534 oscillator, not the price chart. The key thing to remember is that when counting the Elliott wave, and this is extremely important, you must have 100 to 140 bars in that wave that you're counting. If you don't have the correct number of bars, then what you must do is you must adjust your time frame to get that correct number of bars. Once you have the correct number of bars, the Elliott wave practically unfolds right there in your lap. Let's take a couple of examples. Let's say, for example, that we're looking at this bar chart and we want to know what's happening inside here. That certainly isn't 140 bars. Now, this is a daily chart, so to get 140 bars in there, what we have to do is we have to go down to a 45-minute time frame. Now, at this point, we have, this is just over 100 bars. It's about 110 bars here. So the AO becomes absolutely accurate. And if we're counting this wave here, we want to analyze what that wave is. It may look like that's a 1, 2, 3, 4, 5. In fact, most people who count it using the price bars would say that's exactly the count. What we know is that is not the correct count, that this is wave 1, this is only wave 3. This is wave 3, 4 inside of 3, but this tells us that this third wave is not over. The market's going to come back down, most likely to either this point or this point, the previous fourth wave of the lesser degree, and then it's going to go higher. So we can adjust our trading strategy to that. It makes it accurate to count this wave right here. The key again is getting 100 to 140 bars in the wave count that you're counting. Now, the 534 oscillator is a very, very powerful tool, and there are 4 primary uses of that 534. One primary use is identifying the peak of wave 3, and that peak of wave 3 will always, always be a peak in the momentum. Now, what you see here is a peak, then it comes back down and it peaks again. This is a higher price. This tells you that this is the third wave inside that 5-wave sequence, 1, 2, 3, 4, 5 up here. And this momentum, this peak, tells us that the corresponding wave count is a wave 3. We know that that's 3 of 3 and that's 5 of 3 because this did not go below 0. A second primary use of the 534 is determining the end of wave 4, actually when the minimum requirements for wave 4 have been met. Now, what I've done is enlarge this so that you can see that this wave 4 here, the oscillator just barely goes below 0.0. That's okay. In the last several years, the last 5 or 6 years, our staff has looked at literally tens of thousands of charts. And counting the Elliott wave, we have only found 2 errors in this. One was in a 15-minute cocoa chart, one was in a 10-minute sugar chart, and both of those were less than 5/100ths of 1 point. Both of those arrows was that the wave 4 did not quite come down, but it came within 5/100ths of 1 point on this scale. And look at this scale down here. Here's 1,000. We're talking about less than 5/100ths of 1 point. So for all practical trading purposes, this indicator is basically infallible because, again, we've only found 2 errors in literally tens of thousands of charts. So the second job, or the second primary use of the 534, is to tell us when the minimum requirements for wave 4 have been met. Because if we're in a wave 4, we certainly don't want to trade this because 85% of all of our whiplashes happen in wave 4. We want to wait until this crosses 0 before we even start to look for a place to go long or short again. The third use is the end of a trend. The momentum is looking for the end of a trend at the top of wave 5, and that always has divergence in it. And then the fourth reason, fourth primary use, is that it gives us a change in direction. And notice that this change in direction almost always gives you a preview of the price. We call this reading tomorrow's Wall Street Journal. And it's very important that you understand exactly how all of that works. Now, what I'd like to do is look at about 4 or 5 charts, and let's just look at those charts and see what we can learn from this indicator. We know that this is the top of wave 3 of 3. This is 5 of 3, so this is the wave 3 here. We know that this is the minimum requirements for wave 4. Here's another peak inside of the wave 5. And notice that we have divergence between the big wave 3 and the big wave 5 from here to here. And inside of wave 5, we don't really have enough bars here, but we still have divergence. We would have even more divergence if we had enough bars. If we were counting this last wave up here, then we would have divergence and the oscillator would go below 0 on wave 4. So here are our signals here. These are all 4 of them that we looked at again. Let's look at some practice charts now. What we know on this chart, for example, let's back up this chart. We went just a little bit too fast here. Let's back up on this chart. And here we have a big wave up here. We want to know what this is. We have 100 bars about to this point. So we know that this is 3 of 3. This is 5 of 3. So what's coming back is a 4th wave, and then it will go higher. Let's look at another chart to show you the downside. Here we have a downside chart, and notice that this looks like wave 3. If you look at the price chart, it looks like wave 1, 2, 3, 4, or 5 rather, and 1, 2, 3, 4, 5 inside of 5. So if you're looking at the price chart, you would probably come to that conclusion. But looking at this almost infallible indicator here, this is the peak. So we know that this is wave 3. So we're probably going to get a pullback because we have divergence, we have a change in momentum, we have a fractal, we have a squat, we have 5 magic bullets down here, but it's going to change into a wave 4, and if you were a long-term trader, you would still want to be short. You would not want to come out here because you positively know with over a 95% level of confidence that this low is simply not in. So there's an example of a downside, a bearish market. Let's look at another bearish market. This one is different. What we know here is, again, this is wave 3. It has just now fulfilled the minimum requirements for wave 4. This could not be 3 and this 5 because this oscillator, this awesome oscillator here is at its lowest peak at this point. Let's take another example of a down market. This one is different. We know this is not the 3rd wave down here. This is the 3rd wave because the peak happens here, and it does go above 0, signifying that that is wave 4. This is wave 5. So this is a very, very different chart than the one that we just looked at. Let's look at one more here. This one tells us that wave 3 is here, wave 5 is there, and this is another wave instituting here, and this is a wave 5 compared to this long wave here, because wave 3 will always have the peak. And that's it for about day 3 and wave 3 on week 9. We're going to come back tomorrow, and tomorrow what we're going to do is look at the 5 magic bullets in the market, and we're going to practice some more Elliott wave counting. So have a good night. Do all of your stuff you're supposed to do. We'll see you here tomorrow. Well, here we are at day 4, week 9, and what we're going to do today is we're going to practice counting the Elliott wave, and we're going to practice a little bit using the 5 magic bullets. Repeating what we said a couple of days ago, this is very important because the most important information you could possibly have to trade with and invest with is where's the end of a trend. So if we know where the end of a trend is, we can literally make a fortune trading the market. So let's get on with it. Let's practice some more Elliott wave counting. Let's look at some charts here. We're going to put 4 charts up at this point, and what we want to look at is deciding whether we are in a 3rd wave or a 5th wave. And we're putting these charts up. Hopefully they're big enough for you to see, but we want to put all 4 of them up at the same time just to illustrate exactly what we're talking about. Again, if you look at this chart, it may appear, looking at the price chart, that this is a 5-wave move down. All you have to do is glance down here to the awesome oscillator, and you will know immediately that this is only a big 3rd wave. Now, if you want more information, what I suggest you do is to do 2 or 3 things. 3 things, actually. Number 1, go to our first book, Trading Chaos, where there's an entire chapter. Actually, there's 2 chapters on the Elliott wave, and study that, read that over. Hopefully that will help you out. I also suggest that you go to the Computorial, which accompanies this home study program. There are more charts in the Computorial, and you can go at your own speed. You can back up and go forward, whatever you wish, at your own speed. And then the 3rd thing, which I suggest, is that you download the Investor's Dream, which is our proprietary software, and the Investor's Dream will count the Elliott wave for you. Now, we've simplified it in the Investor's Dream, and we just put a line there. It's called the EO, which is the Elliott wave oscillator, and it's based primarily on the 534. And it counts the bars that are on the screen. There's a full explanation of this in Investor's Dream, but if the bar is green, then you're in an impulsive wave, and if the bar is red, then or blue, you're in a reactive wave. So going back to this first chart up here in the left-hand corner, we know that this is the formation of wave 3. The minimum requirements for wave 4 have not been met yet because the oscillator hasn't gone above 0. Let's go over to the right side, the upper right side, and again, we also know that this is just the 3rd wave. It is not the end of a move. It's not the end of a 5th wave. It's simply the 3rd wave. We're going into a 4th wave, and one of the things we know is that the 4th wave oftentimes, time-wise, will take up about as much time as the first 3 waves. So if this took from here to the end of the chart, then we're probably going into a dull trading period for about that same length of time. And this was almost 3 months, so we would expect almost 3 months of difficult trading in this particular commodity or stock. And again, it works exactly the same in both stocks and commodities. Going down to the lower left again, what we see is we have a peak here, which is a 3rd wave. Minimum requirements for 4th wave have been met, so we know that this is a 5th wave. Up here, this is not a 5th wave. That's not a 5th wave. 5th wave inside a 3rd wave, but in a bigger degree, this is 3rd wave, this is a 3rd wave, this is a 5th wave. In the lower right, we have the same thing. This is a 5th wave because this peak is not as high as that peak, and we know that that's a 3rd wave. Of 3, that's 4 of 3, 5 of 3, here's 4, and coming down here, we have the 5th wave. I want to point out something else that's kind of interesting about the Elliott wave. Larger degree Elliott waves seem to spawn off smaller degree Elliott waves that have a family resemblance. For example, here is a 1 degree of a 4th wave, and just look at that. Here is a smaller degree of 4th wave, and you can see sort of the family resemblance. It's an amazing thing once you get involved with the Elliott wave, particularly when you consider all the people who are trading these charts, and you have countries, you have international banks, you have the IMF, you have hedgers, you have commercials, you have very, very large traders, you have commodity and stock funds, you have mutual funds, and you have small retailers like us. And we all have different time frames, different amounts of money, different amounts of ammunition, and our goals are different. And yet it all comes out in the underlying structure of the Elliott wave. And the reason it does that, obviously, is because the Elliott wave is the underlying structure of the market. the underlying structure of the Elliott wave is the fractal. So you have the fractal underlying the Elliott wave and the Elliott wave underlying the market. Now, let's look at some corrective waves. We've looked at wave 3s up here. We've looked at wave 5s down here. Let's look at some corrective waves. And on a corrective wave, we're just going to use one example here because we again suggest you go back to the book and look at the book and look at the Computorial and Investor's Dream. Basically, we'll know that this is 3 of 3 because it did not go above 0. Now, it almost did, but not quite, and that's enough. It's got to get above that 0. So that's 4 of 3, and here is 5 of 3. And notice that there is a divergence between 3 and 5. So that's important, and we want to also look at this one. This one is the end of a wave 3 up here. My little pointer here is not moving too well. It's got a little spasticity in it. This is 3 of 3. That's 5 of 3. This could be A or ABC because it's already gone below 0. So we have to be very careful, but we do have a fractal outside the mouth, and definitely we would be long if it exceeds that. Let's look at one more chart here. And this chart, this is the chart we want. We want to look at these corrections. And these corrections work just like the impulsive moves. ABC has the same personality as 1, 2, 3. Here is A. The bottom there is the 5th wave. This is A wave. This is B wave. This is C wave. C wave will always have 5 waves in it. The B wave will either be a 3 wave or a triangle. And the A wave is the only one that really has any choice in the matter. And the A wave can either be a 5-wave move or a 3-wave move. If it's a 5-wave move, such as in this instance, you will have a zigzag correction, which is exactly what you have. And the target for C is that C will be about the same length as A, which here came out just about that way. So the C wave of the correction has the same personality as a 3rd wave. So a C wave is a tradable wave if you go to a smaller time frame. So that should give you enough to cogitate on here. What we're going to do tomorrow, the 5th day of week 9, is we're going to take a chart that has 5 waves in it, 5 Elliott waves, and we're going to break each one of those impulsive waves down so that you can see the family resemblance, and you can see that there are 5 waves within each impulsive wave. They're waves within waves within waves, and the key to counting Elliott waves accurately in this we'll repeat over and over again, and when you come to the personal tutorial here, we'll practice it over and over on every chart. And that is that the wave count that you are counting must occupy between 100 and 140 bars. So if you were trying to find the exact end of this C wave here, what you would have to do is get the distance between this wave and the end of C, and it must contain 100 to 140 bars. So anything you counted inside this wave here would be totally inaccurate until you went to a much, much smaller time frame. Hopefully that makes all kind of sense to you. The Elliott wave is not absolutely necessary to make profit. The main purpose of the Elliott wave is it gives you confidence. So when you analyze a market and it comes out the way that you expected it to, it gives you the confidence to put on the trades. And that's what we're here for, and that's why we're learning the Elliott wave. You don't have to have it because you can trade the alligator. Anytime the price is outside the alligator's mouth, you know you're in an impulsive wave. When it's inside the mouth, you know that you're in a corrective wave. So that's it. Do your chores. We'll be back tomorrow. Here we are at day 5 of week 9. We're 3/4 of the way through with the home study course, and I hope you're looking forward to joining us right here in the trading room for your personal tutorial. And what we're going to do today is we're going to look at the Elliott wave in detail. We're going to look at a couple of charts. We're going to look at one chart that has 5 waves, and then we're going to break that chart down into the 1st, 3rd, and 5th wave and look at how the family resemblance is and also how we count those waves using the Awesome Oscillator. So let's get right on to it. Day 5, week 9. We're going to count Elliott waves in real time now. And this chart is a day chart, and we're going to break that down to intraday. But just looking at it before we put any helpers on here, we know that this is going to be wave 3. We know that wave 4, minimum requirements of wave 4 have been met when this crosses 0. One of the things we tried several years ago is trading just this AO. And this is kind of a, we've mentioned this before, but it's kind of a little game. If you want to make profit in stocks and commodities, a simplified way to do it, we don't recommend this, by the way, because you can do better than this, but simply watch this AO. When it turns green, which means that this bar is higher than the previous bar, you don't even have to know what the price is. You just simply call the broker and say, buy at the market. Then you hold it as long as it's green. When it turns red, you call the broker and say, sell at the market. Then when it turns green again, you call the broker and say, buy at the market, sell at the market, buy at the market, sell at the market, buy at the market, sell, buy, sell, buy, sell. Now, you will not be maximizing your income or your proficiency as a trader, but it's kind of interesting to be able to tell war stories to other traders that you can make money trading stocks and commodities without even seeing a price chart and without even knowing what the prices are. Just a little bragging point, but we want to do much better than that. We want to get a lot more precise than that. So let's look at this chart. This is wave 1. This is wave 2. Now, there are a couple of interesting things about this particular chart. Number 1 is that wave 2 retraced 100% of wave 1, which in Elliott wave theory, that's quite all right. It can retrace 100%. It cannot retrace more than 100%. So then we come up here, we find that wave 3 is there because we have the peak in the oscillator. Wave 4 comes back here. The minimum requirements are met again when the oscillator crosses the 0 line. And wave 4 retraced 38%. Normally, 9 times out of 10, wave 4 will retrace someplace between 38 and 50% of the time. I think I misspoke there. It's not 9 times out of 10. It's about 80% of the time. This one retraced exactly 38%. Wave 2 retraced 100%. It also crossed 0. The AO crossed 0 there, and that gives us an idea that this is wave 5. Now, again, what we're going to do is we're going to break this wave 1 down into a smaller time frame and look at it. And then we're going to break wave 3 down, look at it, and we're going to break wave 5 down and look at it. So we can count the Elliott waves within waves, within waves, within waves. It's kind of like at the seashore. You can be in different wave counts depending on what time frame you're talking about. If you're talking about the tides, you can have the tides coming in when the waves and the ripples are going out. You can have the waves going out when the ripples are coming in. So it's wave within wave within waves, and that's how the universe works. Let's look at wave 1, a closer look at wave 1, and we'll put everything up here all at once. The wave peak, the oscillator peaked here, did not go below 0 until here, so we know that that's wave 3. It went below 0 here, and notice that it came down, had a long fourth wave here. And remember we said yesterday that the fourth waves can oftentimes take time-wise the amount of time that 1 through 3 did. It took even a little bit longer there. We had divergence between wave 5 and wave 3. The price was higher here, but the momentum was lower there. So the wave 1 within that 5 waves of the last chart has also 5 waves. And look at this, wave 5 within wave 1, wave 5 of wave 1 here has a very clear Elliott wave formation, even though we don't have an adequate number of bars. If we took this wave 5 of wave 1 to a smaller time frame so that that wave had 140 bars, you would have a very similar configuration on the AO. Okay, let's look now at wave 3, the most impulsive wave of the 3. And we want to look, this is the wave 3 inside, and we have a wave 1 up here, a wave 2 here, a 3 there, a 4 there, and a 5 there. And all of this, again, the secret of counting the Elliott wave is counting the wave on the oscillator, not the price bar. So we had a peak on the oscillator, which is one of the primary purposes of the oscillator. It will always, 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 always peak on the third wave. We also crossed 0, which does not tell us that wave 4 is over, but it does tell us that the minimum requirements for wave 4 have been met. And just a hint here, or just another suggestion, look at this bar here. It is a bullish divergent bar, and the price went immediately up. And it also, there's divergence between the price and end of wave 3 and 5, and the momentum between 3 and 5. So that's the third wave inside of that wave we first started looking at today. Let's now go to wave 5 and have a closer look at wave 5. This is wave 5. Wave 5 appears to have an extended 5 wave, but still, even if it's extended, we still have the oscillator working right. Here's the peak on the oscillator, telling us that that corresponds to wave 3. It crossed 0, did not cross 0, notice, until here. I almost did here, but there. So at this point, that's where the minimum requirements for wave 4 have been met. So had you been trading this, or had we been trading it, we would not look for a place to go long until here. We would not go long there, because it had not crossed 0. At this point, we'd be looking for a place to go long, and here's your first fractal outside the mouth, and you would have taken most all of that profit home. And lastly, we have divergence between 3 and 5. Let's look at some unmarked charts now. Looking at that, just as a glance, you should be able to tell and know immediately that this bottom here on the chart that we're looking at is a third wave, not a fourth wave, and that there's no reason to look. We think it's going to go lower, but there's no reason to get short until after this crosses 0. That should be an instantaneous recognition. Let's look at a chart on the up move now. Again, we have a peak here, and at that point, that looked like it was wave 3. But then when this peak exceeded, on the AO, exceeded that, we knew that wasn't wave 3, that was wave 1, and now we're in wave 3. And at this point, we have fulfilled the minimum requirements for wave 4, so we can start to look for wave 5. If we wanted to get more precise, we could break this ABC, if it is an ABC, down into a smaller time frame, and we would be able to count the waves precisely there. And notice that this wave 1 normally will retreat or will retrace between 50 and 62%. It did exactly that. Also notice that there is a squat here, and it is a bullish divergent bar. Hopefully, all of this material is now beginning to paint a very nice broad stroke picture of how the market works and how to trade the markets. Let's look at one more chart, and this chart also is a aggressive move up. And the first thing we want to look at, and when we look at any chart, the first thing I look at is that peak. That we know that's going to be a wave 3 of 1 degree or another, and we have 140 bars on this total wave count up here. So we know that that is wave 3. Now again, since this did not cross 0, we know that that's 3 of 3, that is 5 of 3. So the actual top of wave 3 is here. And then the wave 4, the minimum requirements were met here. Wave 4 came on down, and notice we also had a bullish divergent bar. And this bullish divergent bar had pulled away from the alligator. So if we were very aggressive, we might choose to get on board there because the risk is very little, and we would have an ideal place to get long. And here we have, again, the weak wave 3 and wave 5, but if we wanted to analyze this particular wave, we would have to go to a smaller time frame so that we could get from this point here, the beginning of wave 5 to the end of wave 5, into 100 to 140 bars. So what we've done this week is we've looked at the 5 magic bullets, we've looked at the Elliott wave, how we count the Elliott wave, and once again, if you have any problems with this, we suggest that you go to a couple of 3 other sources that you have in your home study course. One is the book, our first book, Trading Chaos, and the other is the Computorial, and then the third is Investor's Dream. And with that and with this, you should be well prepared. You should be a better Elliott wave counter than probably anybody you know, and particularly any trader you know. This is about the end of week 9. We still have 3 more weeks to go. This weekend, have a very, very special date with your IT. Take care of yourself, have some fun, read about the market, but don't become obsessed with the market. Remember that if it's not fun trading, you're doing something wrong. And hopefully you're getting better, more confidence and better prepared to come to our personal tutorial. And when you come here, we're going to trade together, and hopefully we're going to make a lot of profit together. So have a good weekend. We'll see you back here next week for week 10 of the 12-week home study program. Thank you for being with us.